It's go, 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 go time.
Welcome to the Next Level Mortgaging Podcast. My name is Todd Martin with Mission 35 Mortgages. I'm a level 2 mortgage agent based in Hamilton, Ontario, working here in Burlington, Ontario. We're here to talk about all things mortgages, real estate, and home ownership. Today we're diving into a topic that stops many people from taking their first steps forward in home ownership, mortgage myths, and we're going to bust some of those today. There's so much misinformation out there, and it's no wonder that many buyers feel overwhelmed or think that they don't qualify. So let's go out there, let's break a few of these, some of the top 5 myths holding you back and how we can help you move forward. By the end of this episode, you'll have some clarity and confidence moving forward in your first-time home buyer. Let's start with the biggest myth out there. You need 20% down to buy a home. It's just not true. Well, putting 20% out there can save you from paying mortgage insurance. It's not a requirement. It is a requirement for some purchases. Don't get me wrong. If you're going to buy $1 million house right now, yes, you need to put 20% down. And there are other rules out there. I'm not going to get into everything right now. But if you're going to buy under $500,000, you can put as little as 5% down. If you're going to buy under $1 million, you can put 5% down for the first 500 and 10% between everything from 500 to 999,000. So you do not have to put 20% down. Starting December 14th, that cap goes from 1 million to 1.5 million. So things are changing, and it's going to be a little bit easier for people to get into the market. There are buyer incentives out there to help you get into the market. So if you're holding off because you think you need to save a huge amount of money to get in and buy your first property, reach out, talk to somebody. There are ways to get into this one all the time. You need a perfect credit score to get into the housing market. It's just not true. Don't get me wrong. Having a great, perfect credit score makes things a little bit easier, but it does not have to be perfect. A great score makes things easier. A good score is good. Bad score makes things difficult, not impossible. That's why I work with 50 different lenders out there. There are so many people, so many options out there to make it possible. So I work with A lenders, alternative lenders, private lenders. They all work and do different things with different people. They understand life happens. Maybe missed a payment, rough patches out there. There are all kinds of problems, and we know how to make them work. There are still options for you. What's important is knowing where you stand and working with someone who can connect you with the right lenders. Don't let less than a perfect credit score keep you from getting into the home of your dreams. Fixed rate versus variable rate. Fixed rate is always better than variable rate. It's a myth out there that, because you're locked into a variable or fixed rate that is not going anywhere, that you have a stable payment, that fixed rate is always better than a variable rate. Truth is, it all depends on what your risk tolerance is, what your preference is. Fixed rate is great for some people. I have fixed rate, and I'm not against a variable rate. It just happened to be the right situation at the right time. So which is better for you? It's not one size fits all. It depends on your financial goals, your risk tolerance, and the current market conditions. If you're unsure which route to take, that's why I'm here. I lay out the options, lay out the pros and cons of both, and in the current situations, in the current market conditions. And then you and I sit down together and decide what's best for you. This one makes me laugh a little bit because there's a myth out there that you can't buy a house with debt. Point me to somebody out there that, especially young, moving on, young in life right now, that doesn't have debt. If you're just getting started out there, you have car loans, you have credit card debt, you have student loans, you're a young professional, you're just starting a family, you're a tradesperson out there, whatever it may be, you have debt. It happens. I was that way, and it took a while to get out of it. But that doesn't mean you're not qualified to buy a house. It just means we take that into consideration when we qualify you for what you can buy. That's all. Lenders look at something called your debt service ratio. That means what you have in debt and what you have to pay to make it work. So we take into consideration all of what your payments are going to be in a month and compare it to what you make in a month. And as long as those numbers make sense, the bank will find a way to approve you. That's all. So debt, the key to managing your debt responsibly is showing lenders that you're financially stable. If you're worried about it, we can talk about it and show you how to make things a little bit more appealing to the lenders, and how to make things a little more feasible for you. Okay, so there's a couple points to this one. Pre-qualifications versus pre-approvals versus an application. Okay, a pre-qual doesn't mean you're pre-approved, and pre-approval doesn't mean you're good to go on a purchase. Okay, so a pre-qual just usually means a bank has sent you something that says you're pre-qualified for this amount of money. That just means they've looked at you generally and said, we think if you come in and apply to us, you might get this. It doesn't mean anything whatsoever. Pre-approval means we've taken all your information, forwarded to the bank, and said, we want you to take a cursory look at what we have and tell us whether you think this works. And usually it comes with a rate, hold, and a general amount of what we think you can qualify for or get approval for. So we pre-approve you for, say, $750,000 purchase with a $600,000 mortgage. The bank comes back, says, yes, at this point in time, we will hold this rate for you at 4.5% for 120 days. We think we can make this work. But at that point, you still have to go out and shop, find the house you want to look for, and then put it in an application. And then the real work begins. We will go through everything, go through all the paperwork, and work with the bank to get you actually approved. The pre-approval is different than an actual approval. So there are steps still in between. So just because you have a pre-approval doesn't mean you're guaranteed to get what you're looking for. So there you have it. 5 common mortgage myths busted. Let's do a quick recap. You don't need 20% down. Your credit does not have to be perfect. A fixed rate mortgage isn't always better than a variable rate mortgage. Having debt does not keep you out of buying a home. A pre-approval isn't a guarantee. It's just the next step. Now that you know the truth, I hope you feel empowered, ready to take the next step toward home ownership. Remember, my goal is to make the mortgage process as smooth and as stress-free as possible for you. If you have any questions or you're ready to explore your options, reach out to me at any time. You can find me on Instagram or on my website, toddmartinmortgages.ca. Don't forget to like, subscribe, and share the podcast with anyone who's thinking about buying their first home. Thanks for tuning in. And as always, cheers, guys.